Markets don't usually break when bad news hits. They break when something important changes quietly, and most people are still looking in the wrong direction. Right now, many investors believe they understand what just happened. Prices fell sharply, volatility spiked, the explanation feels familiar. Profit-taking, positioning, end-of-month flows, maybe risk-off sentiment. On the surface, that story sounds reasonable. But here's the question worth asking. What if the price move itself isn't the most important development? In financial markets, price is often the last thing to reflect deeper shifts. By the time price moves violently, positioning, liquidity, and behavior have usually already changed underneath. Professionals don't focus first on the headline move, they focus on what no longer behaves the way it normally does. When a market reacts in a way that contradicts basic expectations, when signals stop lining up the way they usually do, that's when perception needs to adjust. Not because something catastrophic is happening, but because the underlying mechanics may be evolving. This is where many investors make their biggest mistakes. They react emotionally to the visible move instead of calmly reassessing the structure beneath it. They assume today's price tells the whole story, when in reality it may only be a symptom. What matters now isn't fear or optimism, it's understanding whether recent moves are simply volatility within a familiar system or early signs that the system itself is under strain. That distinction changes how risk should be viewed, how patience should be applied, and what deserves attention going forward. Over the final week of January, precious metals experienced unusually sharp price movements within a very short time frame. Silver declined by 22% to $95 per ounce, while gold fell 12% to $419.50, with most of the decline during U.S. trading hours. This coincided with future settlement and portfolio rebalancing, following one of the strongest months for silver in years. Simultaneously, major global mints and distribution channels reported significant stock shortages and delivery delays. From the Perth Mint pausing orders to inventory withdrawals in Shanghai, physical supply was under intense pressure. These facts confirm a rapid price decline in paper markets alongside simultaneous strain in physical distribution channels. While motives remain unassigned, the combination of these conditions differs from routine market corrections. To understand market interaction, we must distinguish between paper and physical systems. Price movements are primarily determined in paper markets. These are highly liquid futures and derivatives that respond instantly to interest rates and currency shifts. Physical markets operate differently. Mining, refining, and distribution move slowly and are less responsive to short-term volatility. Normally, these systems align, but sudden volatility can create dislocations. Mints and retailers may pause sales to manage risk. Who is impacted first? Paper participants feel it immediately, wholesalers are next, end buyers experience it last. Understanding these timelines allows for clearer investment decisions without assuming every anomaly signals a crisis. Periods when price behavior and physical market conditions appear misaligned are not unprecedented in commodity markets. However, history is most useful when it is applied carefully, not as a blueprint, but as a filter against emotional decision-making. One relevant comparison is the late 1970s precious metals market, particularly in silver. In the years leading up to 1979, silver experienced repeated episodes of volatility driven by inflation concerns and currency instability. The most extreme outcomes were preceded by sharp pullbacks and growing strain on delivery mechanisms. Another useful reference point is 2010-2011, when silver prices rose rapidly and retail premiums expanded significantly. Dealers frequently adjusted premiums or limited quantities because operational capacity lagged sudden changes in demand. What matters most in these examples is the conditions that existed beforehand. Volatility increased, availability became uneven, and price signals grew less reliable. At the same time, there are meaningful differences today that distinguish our current market from the past. Silver now plays a far larger role in industrial demand, including electronics and energy transition technologies. Supply growth is constrained as most silver is a byproduct of other metals, limiting how quickly production can respond. Additionally, modern markets are more financialized. Futures, ETFs, and algorithmic trading account for a larger share of volume. Finally, transparency has improved. Inventory data and positioning reports are more visible today than in previous decades. History tells us that periods of sharp volatility are often part of a process where markets reassess value before settling. That perspective helps replace fear with context, and context is essential for disciplined decision-making. When thinking about silver, discipline is key. We shouldn't look for predictions, but for conditional scenarios. Outcomes depend on how variables interact. Here are 3 structured possibilities based on observable conditions. In a bull case, paper market volatility subsides and stabilization begins as leveraged positions are cleared. Physical tightness remains, with delivery delays signaling that demand is structural, not just reactive. The base case is extended consolidation, prices form a range, and physical markets normalize partially. This environment frustrates many. Success here requires patience and careful position sizing. A bear case involves rising real interest rates and a strengthening US dollar, weakening the case for hard assets. Scenario analysis isn't about being right, it's about avoiding large mistakes when conditions change. Prepare for every path. When markets become volatile and narratives multiply, discipline comes from focusing on a small set of indicators that consistently matter. These are not predictors, they are signals, tools to help assess whether conditions are improving, deteriorating, or simply changing character. One of the first indicators I watch is the US dollar index, DXY. Precious metals tend to struggle when the dollar strengthens rapidly. What matters most is not the absolute level of the dollar, but the rate of change. Unexpected rallies create pressure. Sharp, momentum-driven dollar rallies often coincide with pressure on metals, while stabilization tends to reduce that pressure. Closely related are treasury yields, particularly real yields. Rising real yields increase the opportunity cost of holding non-yielding assets. If real yields continue to rise decisively, that would challenge the case for near-term strength. Stabilization removes that headwind. On the macro side, I pay attention to inflation data, especially CPI and PCE, not the headline alone, but how it compares with expectations. Markets respond more to surprises than to levels. Consistently lower than expected inflation would shift capital toward yield-sensitive assets. Conversely, sticky or re-accelerating inflation tends to support interest in hard assets over time as a hedge. Within the metals market itself, volume and liquidity are critical. Large price moves on declining volume often indicate exhaustion. I also monitor open interest in futures markets. Falling prices alongside declining open interest usually suggest liquidation. Finally, I watch physical market signals, but with caution. Delivery times, premiums, and availability trends matter most when they persist. The goal is not to react to every data point, but to observe whether multiple signals begin to align. When they do, risk is easier to define. When signals don't align, patience becomes a strategy. Understanding what to watch is more valuable than trying to guess what will happen. Periods like this test investors not because prices move, but because confidence in familiar signals is challenged. Sharp declines, conflicting data, and elevated volatility naturally pull attention toward headlines and emotions. That is precisely when discipline matters most. Nothing discussed here is a prediction, and it is not investment advice. It is simply a structured way of reading the market as it exists today, through confirmed data, observable behavior, and conditional reasoning. Markets are dynamic systems, and they rarely resolve uncertainty on a schedule that feels comfortable. Risk management, patience, and perspective remain the most valuable tools in uncertain environments. Price alone is rarely the full story, and reacting to it in isolation often leads to poor decisions. Taking the time to understand why markets behave the way they do is far more productive than trying to respond to every move. Whether conditions stabilize, evolve, or change direction, clarity comes from process, not prediction. Over time, disciplined observation tends to outperform urgency. This is simply how I'm reading the market right now, and that reading will adapt as the data does.